Friends, thank you for being here today. Now, let's start with the core question that's probably on everyone's mind. Why can't we just print more money? It is a question that has likely crossed the minds of many, a seemingly simple query that hovers on the edge of economic curiosity. What if I told you that for a country like the United States, running out of its own money is technically impossible? And if it can create money from nothing, why do we have any economic problems at all? Have you ever wondered why countries, seemingly burdened by immense financial obligations, cannot simply print more money to pay off their debts? Why can't this seemingly straightforward solution be applied to solve society's most pressing issues, like feeding the homeless, fixing unemployment, or funding any other critical initiative? This may seem like a rather naive question, and perhaps it is one that people might be a bit too embarrassed to ask. Nonetheless, there is no shortage of people wondering about its answer. The short answer, the one that cuts through the complexity to provide a single powerful warning, can be summed up in just one word: inflation. Inflation is formally defined as a persistent, substantial rise in the general level of prices related to an increase in the volume of money and resulting in the loss of value of currency. When a nation simply creates more money, it does not create more wealth. It merely makes the money that already exists worth less. To truly grasp why this is the inevitable result, we must first establish a foundational understanding of what money itself actually is. To really answer that, we first have to get on the same page about what money actually is. The paper in your wallet or the digits in your bank account may seem concrete, but their value is an elaborate social construct. A critical concept to understand is that modern money has absolutely no intrinsic value. What this means is that the money itself, the physical cotton paper bill or the metal coin, has no actual usable value. It is only considered valuable because we as a society have collectively agreed that it can be exchanged for things that do have value, such as food, housing, and services. If you were stranded on a desert island, a suitcase full of $100 bills would be utterly useless for your survival. Money only has value because we believe it has value. This phenomenon is sometimes described as the Tinkerbell effect, a concept used to describe something that only exists because we collectively believe it exists. Money is a prime example. Hypothetically speaking, if every person on earth suddenly and simultaneously decided that a particular currency or all money had no value, it simply wouldn't. The entire global financial system is built upon this shared belief. Of course, it was not always this way. Money has been around for millennia, and when it was first used, it was in the form of commodity money. This system involved trading items that had actual intrinsic value and practical uses. Civilizations traded in salt, spices, horses, or weapons. Alongside these were precious metals like gold and silver. While these metals technically have limited intrinsic use, their rarity and durability made them almost universally accepted as a store of value and medium of exchange. As societies grew more complex, carrying around large amounts of commodities became impractical. This led to the development of representative money. Since carrying everything you own is difficult, This new system made more sense. In basic terms, you would give your gold, a heavy, cumbersome commodity, to a trusted entity, like a bank, which would keep it safe for you. In return, the bank would give you a piece of paper, a certificate acknowledging that you were the owner of that gold. These pieces of paper could then be used as money, as anyone holding them could at any time go to the bank and redeem them for the actual gold. This was the core principle behind the gold standard. Today, however, almost every country in the world uses fiat money. The word fiat is Latin for let it be done or it shall be. Fiat money is a currency that a government has declared to be legal tender, but it is not backed by a physical commodity like gold. Its value is not derived from what it represents, but from the faith and trust that people have in the government that issues it. Its value is based solely on the market forces of supply and demand. To see this evolution in practice, we can look at the monetary history of a relatively young country. The United States, for example, has gone through all three monetary systems within roughly 200 years. In 1792, when the US stopped using various European currencies, the Coinage Act of 1792 brought about the inception of the US dollar. This dollar was a form of commodity money with coins made from real gold, silver, and copper. Crucially, the value of the metal used to make the coins was exactly equal to their face value. The country then moved on to a mixture of commodity and representative money with the 1900 Gold Standard Act. Under this system, the government issued dollar bills that, in effect, paper certificates, they could be exchanged for a specific amount of gold at any time. This gold standard was an effective way to accurately calculate the exchange rate between countries. For example, if 1 gram of gold cost £1 in Britain and $1.50 in America, then you could easily deduce that £1 was equal to $1.50. Eventually, gold coins were discontinued and silver was removed from other coins, effectively ending true commodity money. This system of representative money ended in 1971. President Richard Nixon officially announced that the United States would no longer convert dollars to gold at a fixed value, thus completely abandoning the gold standard. From that point on, the US dollar, and by extension, most global currencies became pure fiat money. The money we use today is not backed by gold, silver, or anything else of tangible value. It is backed only by a collective belief in its stability and the stability of the government that issues it. This brings us to the mechanics of inflation and how printing money really just devalues it. This brings us back to the original question. Now that we know money is a fiat good, what stops the government from simply printing more of it? The answer lies in the most fundamental law of economics: supply and demand. Basic economics tells us that an increase in the supply of something results in a fall in its demand, and therefore a fall in its price or value. Think of money as any other good. If a new technology suddenly allowed us to create diamonds as easily as we create glass, the value of diamonds would plummet. The same holds true for money. The more money there is in circulation within an economy, the lower the value of each individual dollar. This means other countries using their own currencies can purchase more dollars further devaluing the currency on the global stage. A second supply and demand graph shows why this inevitably leads to a rise in prices for goods and services. When there is more money in the economy, people have more to spend. This causes a massive shift in the demand curve for goods and services. People want to buy more cars, more houses, and more food. However, this sudden increase in the demand for goods is not matched by an increase in the supply of those goods. The country does not magically have more cars, more doctors, or more wheat just because more paper money exists. Since there is a finite number of sports cars in the country and suddenly everyone has more money, they begin to compete with each other to buy them. The only possible outcome is that the price of those sports cars must rise. A simple analogy helps illustrate this point perfectly. Imagine a small closed economy, say a bakery. In this economy, there are five people: Bob, John, Alex, Jack, and Tony. Each of them has $5. In the bakery, there are only 5 loaves of bread available for sale. At a price of $5 per loaf, each person can buy exactly 1 loaf of bread. The market is in equilibrium. Now, let's say the government decides to fix poverty by printing more money. It gives an additional $5 to everyone. Bob, John, Alex, Jack, and Tony each now have $10. They feel richer, so they go to the bakery wanting to buy 2 loaves of bread instead of one. However, there are still only 5 loaves of bread. The bakery cannot instantly produce more. The oven size is fixed, the baker can only work so fast, and the wheat supply is limited. The bakery owner sees these 5 people, each with $10, all competing for the 5 available loaves. The owner thinks people can clearly afford to pay more, so I will raise the price to make more profit. This is just normal human nature and a rational market response. The price is raised from $5 to $10 per loaf. In the end, Bob, John, Alex, Jack, and Tony still only get 1 loaf of bread each, but now they must pay $10 for it. Does printing more money make them richer? No, it does not. Their purchasing power has remained exactly the same. They can still only acquire 1 loaf of bread. Unless the bakery can somehow double its output to 10 loaves, the price will simply double. This inflationary cycle doesn't stop at the bakery. Does this make the bakery owner richer? At first, yes, but remember that all people have more money, including other bakery owners. All these bakeries, flush with cash, now want to buy more wheat to try and meet this new demand. They all start competing to buy wheat from the farmers. But the problem is that wheat must be grown on fields, and fields are limited. The farmers cannot keep up with the sudden artificial demand. This results in the bakeries competing against each other, driving up the price of wheat. As the cost of their raw materials, wheat, increases, bakeries must raise the price of bread even more just to maintain their original profit margins. In conclusion, printing more money without a corresponding increase in the supply of actual goods and services, more bread, more cars, more houses, more technology, leads directly to inflation. Prices rise, and the value of the money in everyone's pocket falls. This is why simply printing money does not solve economic problems. It almost always makes them worse. Now, this explanation leads to a fair question about our modern system. What's the difference between the government and the central bank? This explanation leads to a fair question. If printing money is so dangerous, how did governments fund massive relief packages like those seen during the 2019 pandemic? In March 2020, the COVID-19 pandemic rocked economies worldwide. Millions of people lost their jobs, and many businesses struggled to survive. Governments responded with some of the largest economic relief packages in history. The United States alone spent $2.2 trillion on a first round of relief. So, where did all this money come from? It's a common misconception that the government can just print this money. In most developed nations, there is a strict separation of powers. The government, the political body like Congress or Parliament, is responsible for implementing many types of economic policy, such as decreasing people's taxes or creating jobs through public infrastructure projects. However, it typically cannot just increase the money supply. That power belongs to a separate, independent entity, the central bank. In the United States, this is the Federal Reserve. This bank is responsible for managing the country's money supply and is designed to be independent of the government's day-to-day political whims. This independence is crucial to prevent politicians from printing money to fund their projects, a temptation that history has shown to be disastrous. So, why can't the central bank authorize the printing of unlimited money to help an economy in crisis? They could, but they understand that this is a short term solution that does not boost long term economic growth. As our bakery analogy showed, it can actually hurt the economy by triggering rampant inflation. You might think no country would actually be foolish enough to do this, but let's look at some real world case studies in disaster, starting with hyperinflation. Now that you realize printing more money sounds like a terrible idea, you might be sure no country would ever actually do it. Well, some countries have, and the results have been catastrophic. Economists generally agree that a small, stable inflation level of around 1 to 3% is optimum for a healthy, growing economy. In the United States, inflation is typically targeted at around 2% per year. At this rate, prices would double approximately every 35 years, a manageable and predictable change. A country is said to have entered hyperinflation when its inflation level exceeds a devastating 50% per month. This is not a theoretical concept, it is a real world disaster that has ruined nations. Case study 1: the Weimar Republic, Germany, 1920s. After the German Empire lost World War I, it was abolished and replaced by the Weimar Republic. The new Germany was severely devastated by the war, with its infrastructure in ruins. To worsen matters, the Allied forces imposed hefty war reparations based on the Treaty of Versailles. The economy was in shambles, unemployment was rampant, and the government had no money. In a desperate attempt to pay off these reparations and cover its debts, the government resorted to the only tool it had: the reckless printing of money. The result was one of the most famous examples of hyperinflation in history. Prices skyrocketed at an alarming rate. By November 1923, prices were doubling every few hours. People needed wheelbarrows full of cash just to buy basic necessities. A loaf of bread that cost 250 marks in January 1923 skyrocketed to an incomprehensible 200 billion marks by November of that same year. This hyperinflation destroyed the savings of the entire middle class, destabilized the economy, and contributed to massive social unrest, which in turn paved the way for the rise of extremist political parties. Case study 2, Hungary, 1946. As ridiculous as the Weimar situation was, it is only considered the second worst inflation in history. The record for the highest monthly inflation belongs to Hungary in 1946. In July of that year, Hungary's highest monthly inflation rate reached 41.9 quadrillion percent. Prices were doubling every 15 hours. Their currency was called the pengo. As inflation rose, the government printed notes with higher and higher denominations, such as the bill pengo, short for a billion pengo, which was actually a trillion on the short scale. Hungary holds the record for the highest denomination banknote ever issued, the 100 million bill pengo note. That is 100 quintillion pengo. In 1941, the exchange rate was about 5 pengo to 1 US dollar. By 1946, when the currency was finally discontinued, things had gotten so out of hand that if you took every single banknote in the entire country, their total combined value would be 1/10 of a single US penny. The country then switched to a new currency, the forint, at a rate where one forint equaled 400 octillion pengos. That is a number with 29 zeros. Case study 3, Zimbabwe, 2000s. A more recent example is Zimbabwe. In the 2000s, under the rule of President Robert Mugabe, a series of land reforms and economic mismanagement, coupled with international sanctions, plunged the country into chaos. Food production collapsed. When the economy took a turn for the worse, Mugabe's government did what so many before had done. It printed money to pay for government expenditures. This caused inflation to skyrocket. By mid November 2008, Zimbabwe's peak inflation reached an official mind boggling figure of 89.7 sextillion percent. That number has 22 digits. It got so bad that prices doubled every 24 hours. The government tried to solve the problem by printing more and more money with higher and higher denominations, including the infamous $100 trillion bill. People were literally using wheelbarrows full of this cash to buy a single loaf of bread. In 2009, the Zimbabwean dollar was officially abandoned. To this day, the country has no national currency of its own, and its people use foreign currencies like the US dollar. Case study 4, Venezuela, 2016. This is not just a historical problem. Venezuela has the largest proven oil reserves in the world, even more than Saudi Arabia. As a wealthy oil country, it became heavily dependent on this single resource. Before 2008, when oil prices were high, Venezuela was rich, selling oil and making tons of money. However, its socialist government used this money to provide massive public subsidies, fixing prices at very cheap rates to keep the people happy, rather than investing in developing other industries. when the massive drop in oil prices came after 2008, Venezuela's income collapsed. The government, worsened by rampant corruption and mismanagement, faced a crisis. They could not stop the subsidies without angering the people, so they continued them by printing more money. This excessive printing led to hyperinflation. The currency became so worthless that people were seen throwing it on the streets as it could not buy anything. This example shows how printing money can have disastrous consequences, even for a country with immensely valuable natural resources. These stories are pretty extreme, so let's take a moment to address some common nuances and modern policies like these stories clearly show that simply printing money to pay for public expenses is a disaster. But what about more subtle arguments? You might be asking, okay, but why not just print money only to pay foreign debt? You might ask, what if the government prints money but doesn't give it to its people? What if it just uses it to pay off foreign debt? When a country prints more money, it becomes noticeable to the entire world through economic reports, currency markets, and inflation indicators. Even if this new money is only used for foreign debt, it still increases the total supply of that currency. This makes the currency less valuable and, crucially, less trustworthy in the eyes of foreign creditors. Foreign creditors, the people and countries who loaned you money, will not accept this devalued money. They would see it as toy money and lose all trust in the country's economic reputation. This would harm the country's stability and its ability to ever borrow money again. This is why a country's national debt is so complex. Take the United States, which has the highest national debt, currently around $17 trillion. It is a common misconception that this debt is owed to other countries in the way a person owes a bank. While China does hold about 8% of this debt, it cannot just knock on the door of the White House and demand $1.2 trillion. Most of the debt is actually owned by the US government itself in organizations like Social Security or by US citizens. This debt is in the form of treasury bonds. The US is considered an extremely risk free investment because the world trusts that it will not default on its debt, and just as importantly, will not simply print money to pay it, thereby devaluing the bonds. And this brings us to a more modern and controversial alternative, quantitative easing, or QE. So, how did the central bank create the $2.2 trillion in 2020? They used a relatively new and controversial tool called quantitative easing, or QE. This is not equivalent to simply printing money and handing it out. In this approach, the central bank creates new digital money. It then uses this new money to purchase financial assets, usually bonds from corporations or the government. When an individual buys a bond, they use money that is already in circulation. But when the central bank buys a bond, it essentially creates new cash, supplying money that did not exist before in exchange for that bond. During the 2008 financial crisis and again in 2020, the US Federal Reserve bought unlimited US Treasury bonds. This had two effects. First, it loaned the government an unprecedented amount of money, which the government could then use for relief efforts like stimulus checks. Second, and perhaps more importantly, by buying so many bonds, the Federal Reserve effectively lowered the financial return on them. This made these super safe bonds less attractive to investors. This, in turn, incentivized those other investors to lend their money to riskier entities like small and mid sized companies in order to get a decent financial return. Encouraging this kind of lending, in theory, helps companies of all sizes borrow money to funnel into new projects and new hires, boosting the real economy over time. This isn't the same as just printing money and giving it to people. It's a complex, indirect mechanism aimed at stimulating real economic activity. However, it is still a subject of intense debate. Some economists have raised concerns that a central bank buying government debt is a subversion of the system, a backdoor to financing government spending. Others insist these measures were necessary and helped stabilize the global economy. QE is still relatively new, and its potential long term consequences are still unfolding. Now, this discussion of QE and government debt leads us to a fascinating and very controversial modern idea. What about modern monetary theory, or MMT? This brings us to one of the most hotly debated economic topics today, one that speaks directly to our original question. This is modern monetary theory, or MMT. Proponents of MMT look at our current fiat system and draw some very different conclusions. Their core argument is this: a government that controls its own fiat currency, like the US, the UK, or Japan, can never involuntarily go broke in its own currency. Why? Because that government is the issuer of the currency. It can quite literally create any amount of money it needs to pay for things it has promised to pay for in its own currency, whether that's Social Security, military salaries, or interest on its bonds. From this perspective, the government doesn't need to get money from taxes or borrowing in order to spend. Instead, MMT argues that the government creates money when it spends. So, when proponents of MMT are asked why not just print money to fund projects, they might say we can and we should up to a certain point. They see this money creation ability as a powerful tool to achieve public goals, like a federal job guarantee, tuition free college, or a Green New Deal. In their view, the government can simply spend the money into existence to fund these programs. But, and this is the critical part that separates MMT from the just printed chaos of Zimbabwe. They argue that the true limit on government spending is not a budget deficit. The true limit is inflation. MMT advocates agree that if you pump too much money into the economy, you'll get inflation, just as we discussed, but their choke point is different. Inflation, in their view, only happens when government spending outstrips the real productive capacity of the economy. That is, when you run out of available workers, raw materials, and factory capacity. As long as there are unemployed people who want to work or unused factories, MMT argues that government spending can be increased to employ those resources without causing inflation. And what happens if inflation does start to rise? Mainstream economics would say the central bank should raise interest rates. MMT proponents argue for a different tool: taxes. In their framework, taxes are not primarily for funding the government. Taxes are for managing inflation. By raising taxes, the government pulls money out of the private economy, reducing spending power and cooling down inflation. So, how does this differ from our case studies? MNT advocates would say that Zimbabwe printed money in a desperate attempt to pay for things without having the productive capacity to back it up. MMT argues for printing money specifically to create new value, to build a bridge, to employ a worker, and then using the tax system as a brake pedal to keep the economy from overheating. As you can imagine, this is extremely controversial. Mainstream economists and policymakers express major concerns. Their primary criticism is political. Can we really trust politicians to do the responsible thing and raise taxes, a deeply unpopular move at the exact moment the economy is overheating? History suggests this is unlikely. Critics fear that MMAR's framework would, in practice, open the floodgates to reckless spending, unleashing the very hyperinflation we've seen in our historical examples. They argue that while the theory might sound coherent, the real world political application would be a disaster, underestimating just how quickly inflation can spiral out of control once public trust in a currency is broken. So, after looking at all of this, it's clear we need to talk about the real solution, which is all about creating value, not money. From the disastrous stories of hyperinflation and even the complex debates around QE and MMT, we can learn a crucial lesson. Printing more money, whether physically or digitally, might seem like an easy fix for poverty and economic problems, but it actually causes far more harm than good, or at the very least, carries immense risks. The key takeaway is that simply creating more money without increasing production just makes prices more expensive. So, why do people want money? They want to use it to buy the things they need and want. But what is the point of having billions of dollars if there is only one loaf of bread, or worse, no bread at all? In the end, as the saying goes, you can't eat money. If money cannot be exchanged for real goods, the money itself becomes useless. So, what is the correct solution? If printing money is not the answer, what is? The answer is that governments must focus on creating value. This means investing in the real foundations of an economy. It means investing in education to create a more skilled and productive workforce. It means building infrastructure, roads, bridges, and high speed internet so that goods and services can move more efficiently. It means supporting technology and innovation to create new products and industries. It means helping businesses grow, managing resources efficiently, and fostering a stable, predictable environment for economic activity. If there is a high supply of goods and a high demand from people who have jobs, prices will stabilize. When a government supports businesses to produce more, those businesses will hire more people. This creates jobs, and the products they make become more common and affordable. The people who get these jobs can then afford to buy those products. And because they work to earn their money, they value it and are more mindful of their spending, which helps keep demand in check. In this high supply, high demand scenario, sellers cannot just raise prices because the products are so common that there are plenty of competitors. This is the path to real prosperity, the path taken by successful countries. If money grows on trees, it will be as valuable as leaves. True wealth is not found in printing paper. It is found in the production of real goods and services by a skilled, educated, and productive society.